Welcome to the Deep Dive, where we break down the sources so you get the insights you need, fast.
Good to be diving in again.
Yeah, absolutely. Today, we're looking at Parker-Hannifin Corporation. They just released their fiscal year 2026 first quarter earnings.
And it was quite the quarter.
It really was. The mission today is, well, to get past just the big headlines. Parker reported several major records, sure, but maybe more importantly, they significantly raised their full-year outlook.
Right.
So we're here to unpack what's actually driving this performance and, what these higher expectations really mean going forward.
And I think to really get how they pulled off a quarter like this, you kind of have to understand their core setup. They call it the win strategy. It's fundamentally built on this very decentralized structure. Think about it, 85 divisions. Each one has a general manager, full P&L responsibility.
Wow, 85?
Yeah, it encourages that local ownership, fast decisions, and that's really the engine that lets them turn sales growth into, well, better margins.
Okay, let's unpack this scorecard first then, focusing on that leverage you just mentioned.
Sounds good.
Sales hit a record $5.1 billion. That's solid 5% organic growth. But for you listening, what's the bigger story here, the top-line sales number, or how they actually turn that into profit?
Oh, it's absolutely a margin story, no question. Adjusted segment operating margin, a record 27.4%. That's a huge jump, 170 basis points year over year.
Okay.
And it's that combination, right? Mid-single-digit sales growth, but paired with really strong margin expansion. That's the critical piece, because that's what launched adjusted EPS to a record $7.22, a 16% increase.
That leverage is clearly paying off then, and even their cash generation looked pretty robust. Record cash flow from operations, $782 million. That's 15.4% of sales. And considering Q1 usually isn't their strongest cash quarter, they tend to be more second-half weighted. That's a pretty noteworthy performance.
It really speaks volumes about let's say, the quality of the earnings. I mean, if you break down that EPS growth, the to increase 80 cents of that came straight from segment operating income,
right,
which was up 10% in dollar terms. So the vast majority of the EPS jump, it's core operational execution, good cost management across the board. And, you can't forget their safety focus, too. They mentioned a 20% drop in incident rates, top quartile stuff.
Okay, so if the margin story is the real headline, we need to figure out where that expansion actually came from.
Exactly.
And this is where it gets, I think, really interesting. The segments show, well, a super strong aerospace market, still, combined with what looks like a long-awaited industrial recovery finally kicking in.
Yeah, let's start with aerospace systems. I mean, they're just operating on another level right now. Record sales again, $1.6 billion. That was driven by 13% organic growth.
13%.
And what's really remarkable here is this is the 11th quarter in a row of double-digit organic growth for them. Commercial OEM, that was the real powerhouse within aerospace, up 24% compared to last year.
And that operational leverage you talked about, it hit a pretty major milestone in aerospace, didn't it?
It really did. For the first time ever, their adjusted segment operating margin for aerospace hit 30.0%. 30%.
30%.
Yeah, up 210 basis points from the year before. And that performance, it's really down to strong demand for aftermarket services and solid productivity gains. Plus, they've got a record backlog, orders up 15%. It just suggests there's more room to run.
Okay, let's switch gears then to the Diversified Industrial segment, or DI, specifically North America. Sales there were over $2 billion. And organic growth, crucially, finally went positive, 2.1%. Now, given this is the first positive print in, 7 quarters for North America DI, is that 2.1% just, easier comparisons? Or are we actually seeing a real sustainable pickup in industrial demand?
That is the right question. And I think it's more than just easy comps. Look, it's not like a V-shaped snapback, maybe more like a big ship slowly turning. The growth was pretty broad, too. Specifically saw strength in their industrial aerospace and defense businesses, in-plant and industrial equipment, and actually a much better performance in off-highway than expected.
And the margins held up.
They did. That operational discipline meant DI North America also hit a record margin 27.0%. That's a really good sign that this recovery, even if gradual, is profitable.
Okay, so if North America is finally turning positive, how did the international side of DI do? Record sales there too, $1.4 billion, but organic growth was slower. Only 1.0%.
Yeah, and performance really varied quite a bit by region. Asia Pacific was definitely the bright spot, up 6.1% organically. But EMEA, Europe, Middle East, Africa, that region stayed challenged, down 2.6% organic. Latin America was basically flat. But despite that sort of choppiness, the international teams really showed resilience. They leveraged their cost controls, executed on that win strategy, and managed to hit a record segment margin of 25.0%, up 90 basis points year over year. Pretty impressive execution.
All right, let's pivot then to strategy and portfolio changes. They closed a pretty big deal during the quarter, Curtis Instruments, about $1 billion.
That's right, closed in September, about $1.0 billion net of the cash they acquired.
So why spend $1 billion on this specific company? What's the key strategic advantage here, beyond just, adding revenue?
The focus is really all about positioning for the future in mobile machinery. Curtis is a leader in electric and hybrid vehicle motors, controllers, things like that.
Ah, electrification.
Exactly. This deal gives Parker critical capabilities there, complementing what they already do in hydraulics and pneumatics. It's basically about making sure they remain the key supplier as that whole mobile machinery market shifts more towards EV and hybrid.
Okay, that makes the long-term thinking much clearer. How does it fit into the numbers for this year, the revised forecast?
Well, the integration's already started. It added about $235 million to the sales guidance for the rest of fiscal 26. That's roughly 1% of total sales.
Good.
Now, initially, it's a bit margin dilutive. The margins are probably high teens, low 20s to start, but they do expect it to add to EPS even in this first partial year.
Got it. Let's spotlight a couple of their key growth areas they talked about. Energy, that's about 7% of their revenue, mostly supplying heavy-duty gas turbines for power generation. What makes that important for them long-term?
Well, it's really seen as a long life cycle business. That means durable aftermarket revenue streams, multi-year backlogs, which gives them stability.
Right.
And what's really key is the technology crossover, the stuff they develop for these turbines. A lot of it is shared across their aerospace and other industrial markets. That creates internal efficiencies, a competitive edge.
It also flagged a smaller but fast-growing area that seems very relevant right now, data centers and liquid cooling.
Yeah, that's right. They're seeing really rapid growth using their sort of interconnected technologies for liquid cooling systems components, basically capitalizing on that huge trend of increasing power density in data centers. It's tiny right now, less than 1% of total sales, but it really shows how they can adapt their core fluid control tech to jump on these new high-growth industrial needs pretty quickly.
Okay, shifting to how they're deploying capital. They raised their CapEx forecast for the full year. What's that extra spending focused on?
Yeah, CapEx is now forecasted around 2.5% of sales. That money is really about getting ready for future growth. Think automation, safety improvements, and adding capacity in specific regions where demand is really high.
And M&A, still active.
Very much so. They said the pipeline is very active, still looking for those strategic, disciplined deals. And they're continuing the share buybacks too, repurchase $475 million worth in Q1 alone.
Okay, so you add up the strong Q1, the operational leverage really working, these strategic moves. It clearly led to a big boost in confidence. They raised the full-year guidance pretty significantly across the board: sales, margin, EPS, free cash flow.
Yeah, the strength really comes through when you look at the revised forecast for their key markets. Overall, organic growth guidance lifted from 3% up to 4% at the midpoint. And crucially, aerospace and defense got a nice bump, up from 8% growth expected, now to 9.5%. That just confirms that continued strength in commercial planes, both new builds and aftermarket.
And that industrial turnaround we talked about, that's reflected in the new forecast too.
Absolutely. Take off highway machinery. They previously expected a low single-digit decline for the year. Now, they've raised it to basically neutral.
Flat. Okay.
Yeah, reflecting a gradual recovery in construction, even though, the agriculture market is still pretty tough. And maybe the biggest surprise was HVACR heating, ventilation, air conditioning, refrigeration.
What happened there?
They raised that outlook from low single digits all the way up to positive mid-single digit growth. They cited some big wins in commercial refrigeration and filtration.
Interesting. Any weak spots still?
Yeah, the one really challenged market remains transportation. They're still forecasting a mid-single digit decline there, basically saying don't expect any recovery in the truck market this fiscal year.
Okay, so the final number that kind of sums up all this confidence.
Yeah.
The adjusted EPS forecast.
All right, the headline number. The midpoint was raised right up to an even $30 per share for the full year. That's a solid 10% increase compared to last year's actuals.
$30, that's a big number.
It is. And importantly, that profit is backed by strong cash flow expectations. They raised their free cash flow guidance range to now $3.1 billion to $3.5 billion. And they reconfirm they expect conversion free cash flow divided by net income to be over 100% for the year.
So we started this deep dive looking at a really record-breaking quarter, showing improvement pretty much across the board. And it all culminates in this significant hike to the forecast for the rest of fiscal 26.
So what does this all mean, right? I think the ability to expand margins so substantially. Remember, the full-year adjusted operating margin guide is now up 50 basis points to 27.0%. Doing that even while navigating these, still choppy international markets like an EMEA and that really challenged transportation segment, it just highlights how consistently their underlying business strategy is working. That decentralized win strategy, it's proving it can drive leverage, really, regardless of the broader economic ups and downs.
It really does feel like the operational execution has become the ultimate story here.
Yeah.
I mean, Parker hit that record 30% margin in aerospace for the first time ever.
Right.
Now think about this. Their previously stated long-term target for the entire company's adjusted operating margin was 27.0%, and that was for fiscal year 29.
Good point.
So how quickly could this relentless focus on operational excellence push their total company margin well beyond even this newly increased guidance for this year? And what new market needs, maybe like that data center liquid cooling or the ongoing power gen build-out, what will fuel that next phase of margin expansion driven by those 85 decentralized owner managers? That feels like the big strategic question for the next few years.
Absolutely.
Well, we hope this deep dive gave you the context and the critical insights you need on Parker-Hannifin's impressive quarter and their raised outlook.
Yeah, definitely a lot to track there.
Join us next time as we continue searching for the essential knowledge you need to stay ahead.